The double exponential moving average, or DEMA, reduces the lag of traditional EMAs, making it more responsive and better suited for short-term traders. DEMA was developed by Patrick Malloy and introduced in the January 1994 issue of Technical Analysis of Stocks and Commodities magazine. The overlay uses the lag difference between a single smoothed EMA and a double smoothed EMA to offset the single smoothed EMA. This offset produces a moving average that remains smooth, but stays closer to the price bars than either the single or double smoothed traditional EMA. The formula of DEMA is as shown on the screen. Single and double smoothed EMAs. EMA1 equals EMA of price. EMA2 equals EMA of EMA1. DEMA equals 2x EMA1, EMA2. Essentially, the formula takes the lag difference between the somewhat lagging single smooth EMA1 and the even more lagging double smooth EMA2. Then subtracts that difference from EMA1. This calculation produces a smooth line that is much closer to the price bars than either EMA1 or EMA2. DEMA is interpreted in a similar way to traditional EMAs, but responds more quickly. Like other EMAs, it can be used to confirm a trend or spot a change in the trend. The most commonly used signal is the DEMA crossover. Watch for the DEMA line to cross the price bars, or for a shorter-term DEMA to cross a longer-term DEMA, to indicate a change in trend. For example, the 20-day DEMA crossing above the 50-day DEMA would be a bullish signal. These DEMA crossovers, whether of price or another DEMA, typically happen much earlier than the corresponding traditional EMA crossover. In the example below, the green arrows mark DEMA crossovers and the blue arrows mark the corresponding EMA crossovers. In both cases, the DEMA crossover happens before the EMA crossover. Keep in mind that because DEMA reacts more quickly than traditional EMAs, your trading strategies may need to be adjusted for use with DEMA.